Crypto world faces a fateful choice, MC Pro. Hey guys, what's up? Welcome back to our YouTube channel. Today we'll be looking at the crypto world facing a fateful choice. Before we start, I would like you to hit that red subscribe button so that you never miss out on any of our videos. Stay tuned till the end for amazing content. Monetary authorities around the world are rushing to design digital currencies, and many are asking, who knows how to do this? Some of the first governments to go digital have found an answer in cryptocurrency enthusiasts. For these rebels against traditional approaches to finance, the digital trend presents an opportunity to create virtual money for a whole nation. Adam Samson is a character in the film Adam and Eve. Crypto asset companies must either learn to coexist with authorities or suffer their fury. One of the biggest attractions for staunch supporters of digital assets is that many of them are ostensibly beyond the grasp of government and monetary authorities that regulate traditional markets. While the dream of a decentralized financial system remains alive and well in the crypto community, what has emerged is an industry dominated by huge financial institutions. Big crypto exchanges include crypto asset companies must either learn to live with regulators or face their wrath. One of the main attractions or die-hard proponents of digital property is that many of them are ostensibly outside the reach of government and financial authorities who regulate activity in traditional marketplaces. While the dream of decentralized monetary systems lives on in the crypto community, what has emerged is a market dominated by extremely large financial institutions. Huge crypto includes exchanges like Coinbase and Finance, as well as stablecoin issuers like Tether and USD coin sponsor Circle. Every month, billions of dollars are exchanged, and the market value of just the two largest stablecoins has surpassed $90 billion. This activity is increasingly spilling over into the strictly regulated traditional monetary system. Many exchanges allow withdrawals and deposits from bank accounts and major credit cards. According to its issuers, Tether and USD Coin are backed by reserves that represent short-term debt issued by traditional firms. This means they could become systematically important outside of the crypto market, which has alarmed the Federal Reserve and rating agency, Fitch. Crypto companies are also rushing to enter the public equity market. Coinbase, situated in the United States, debuted on Wall Street this year, whereas Circle plans to make its debut in New York via a take-care of a listed funding vehicle. High-profile financial firms and hedge funds are also interested in participating. The trade's meteoric rise and vast ambitions have been fueled in part by its ability to operate with the transfer quick and break issues approach. Regulators were able to dismiss cryptocurrency as a distraction when it was still in its early stages. However, monetary regulators are wrestling with a serious problem. How can they ensure that cryptocurrency isn't used for money laundering or terrorism financing? How do they protect their customers from such scams and schemes? When does huge crypto start posing a systematic risk to traditional asset markets? This spike of supervisory curiosity is a serious threat to certain players, but it also creates an opportunity for others. It's caused a bit of a schism in the crypto market. By professing their compliance credentials or discussing their business practices in detail, some operators gradually gain officers' trust. Others are taking advantage of the opportunity to catch up. We are right in the middle of the storm. Ian Taylor, the executive director of Crypto UK, a trade body that represents the industry, said, "Many early adopters must change their thinking from being outside a centralized administration to becoming enormous mainstream operators," he said. In the end, this path will be beneficial to the sector's prospects. Many members of the cryptocurrency community are concerned that a few bad actors would destabilize the system for everyone. A major meltdown might undo the progress made by the proponents who have worked for years to persuade customers, investors, and regulators of their vision for the future of finance. Some businesses are making success in this area. Changes in Hong Kong Crypto.com, for example, said last week that it had become the first foreign crypto company to obtain a digital money business license in Malta, allowing it to issue charge cards and enable bank transfers to users. Gemini, a crypto firm founded by the Winklevoss twins, is one of the few operators in the UK to be permitted by the Financial Conduct Authority to become a licensed crypto asset firm. On the other hand, regulators are stepping up their monitoring. Tether and ShiftBitFinex, for example, agreed to pay an $18.5 million penalty in February after New York's Attorney General claimed they had recklessly and criminally lined up significant monetary losses. Neither organization admitted to any misconduct. Last month, the FCA issued a consumer warning against Binance, one of big crypto's most important players, which has been criticized for its compliance policies. Regulators are closing in on the market. Large crypto terms that enjoy market management will be subjected to increased demands for compliance, transparency, and consumer protection. Twitter CEO Jack Dorsey confirmed to investors that Bitcoin will be a big part of the company's future as he sees opportunities to integrate the cryptocurrency into existing Twitter products and services, including commerce, subscriptions, and other new additions like Twitter Tip Jar and Super Follows. Dorsey has been a staunch Bitcoin advocate for years, but how it would be put into action on Twitter's platform had not yet been spelled out in detail. More recently, Dorsey launched a $23.6 million Bitcoin fund with Jay-Z and announced plans to lead his other company, Square, into the decentralized financial services market by way of Bitcoin. The price of Bitcoin dropped below $30,000 late Monday night for the first time since June 22nd, dragging other digital coins lower with it. Bitcoin is trading in the $29,000 range, about 3% lower on the day, according to Coinmetrics. Ether is down 1.25% and XRP fell 4%. Even with the plunge, Bitcoin is up 2.3% for the year. According to CoinDesk data, Ether and XRP are both up about 140% for the year. The plunge came amid news that New Jersey Attorney General issued a cease and desist order against the New Jersey-based crypto services firm BlockFi, ordering it to stop offering interest-bearing accounts, according to Forbes and later confirmed on Twitter by the company's CEO. It also came after a big sell-off in global stock markets Monday when the Dow Jones Industrial Average had its worst day since last October, though the markets reclaimed much of their losses Tuesday. There's been a broad sell-off in global markets. Risk assets are down across the board. Annabelle Huang, partner of cryptocurrency financial services firm Amber Group, said, "There are concerns of the quality and strength of economic recovery, and broader risk assets turned weaker, including high yields," Huang said. Coupled with recent BTC weaknesses, this just sent crypto market down further. At one point early Tuesday, about $89 billion was wiped off the entire cryptocurrency market in a 24-hour period. Since Bitcoin's all-time high of nearly $65,000 in mid-April, its price has plunged over 50%. Regulatory scrutiny. A renewed crackdown in China on cryptocurrency trading and mining has weighed on the Bitcoin price. Major regions responsible for Bitcoin mining in China have forced operations to shut down. Bitcoin mining is an energy-intensive process that facilitates Bitcoin transactions and creates new coins. China's central bank has also spoken to finance and fintech companies, reminding them not to offer crypto-related services to customers. China banned local cryptocurrency exchanges in 2017, forcing them to move offshore. That did not stop Chinese traders buying and selling digital coins, but the tough actions this year from Chinese regulators has looked to further tighten restrictions on trading and mining. All signals are red as BTC continues to be weighed down by China's ultimate crypto ban and worsening macroeconomic conditions from a surge in COVID variant, said Joe Honshu, founder of cryptocurrency-focused venture capital and trading firm Kinetic Capital. Regulators around the world are also looking more closely at the crypto space. Binance, the world's largest cryptocurrency exchange, last month was barred by UK authorities from carrying out any regulated activities in the country. Regulators in Japan, Canada, and Thailand have also issued warnings about Binance. In general, we're seeing more regulatory focus on crypto and Bitcoin, said Vijay Ayer, head of business development at cryptocurrency exchange Luno. More selling ahead. Bitcoin's fall below $30,000 could be important, according to Ayer, who said the sell-off could go lower to test the $22,000 to $24,000 level. From then on, Bitcoin could trade in a range. I would see Bitcoin between $20,000 to $40,000 for a while now before any bullishness returns, Ayer said. Kinetic Capital's Chu also seen potential selling ahead. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss out on any videos in the future.